Hello class, today we're continuing with Chapter 8, Personal Finance. Today we'll be looking at 8.5, Annuities, Methods of Saving and Investments. Important to save your money for the future. Alright, our objectives today are to determine the value of an annuity, determine the value of an annuity using a spreadsheet, determine regular annuity payments needed to achieve a financial goal, determine regular annuity payments using a spreadsheet, understand stocks and bonds as investments, read stock tables, understand accounts designed for retirement savings. Now let's start with some definitions here. An annuity is a sequence of equal payments made at equal time periods. The value of an annuity is the sum of all deposits plus interest paid. So in example 1, we will determine the value of an annuity. You deposit $1,000 into a savings plan at the end of each year for 3 years. The interest rate is 8% per year compounded annually. Let's find the value of the annuity after 3 years, and then let's find the interest that we gained on that annuity. Alright, so let's look at the solution here. For part A, the value of the annuity after 3 years is the sum of all deposits made plus all interest paid over 3 years. So let's kind of break it down year by year. The value at the end of year 1 is $1,000. The value at the end of year 2 will be the $1,000 times 1 plus 8% plus the initial $1,000 from that year 1. So the value at the end of year 2 will be $2,080. Okay, so we don't earn any interest at that first year. That's the first time that we basically put that $1,000 in the savings plan. But at the end of year 2, we earn 8% on that $1,000 that's been sitting in there for a year, and then we're going to put another $1,000 in there at the end of year 2 to compound to be $2,080 at the end of year 2. Now we're going into year 3 now. We're going to take what we earned in the first 2 years, which is $2,080, multiply it by 1 plus 0.8. So we'll retain the initial value with the 1, add an additional 8% because that's the amount of interest we're gaining on that investment, and we're going to add another $1,000 that we're paying into that annuity at the end of year 3. So we'll have $2,246.40 plus the $1,000 that we're paying that year for $3,246.40, and that will be the value of the annuity at the end of those 3 years. So you're kind of working up year by year to see what you make at the end of each year, adding it to the next year, because we're not taking anything out of this annuity, and we continue to add to each annuity at the end of each year. Okay, so we have a total value of the annuity at the end of 3 years of $3,246.40. We personally made 3 payments of $1,000 each, which means we deposited a total of $3,000 of our own money, and the value of the annuity wound up after 3 years being $3,246.40. Therefore, the interest that we have here would simply be the total value of the annuity minus the amount that we put in. So we have $3,246.40 minus $3,000, which gives us $246.40. That amount right there is our interest that we earned on our annuity after 3 years. Now, the value of annuity, interest compounded once a year. So we're going to look at this value of annuity with the interest compounded once a year, and we're going to give it a formula. So if P is the deposit made at the end of each year for an annuity that pays an annual interest rate R in decimal form, compounded once a year, the value A of the annuity after T years is A equals P times 1 plus R raised to the T minus 1 all over R. Okay? So suppose we're going to use that equation now. We're going to use that equation that we just reviewed, that A equals P times 1 plus R raised to the T minus 1 all divided by R. We're going to use that in this next example to determine the value of an annuity. So instead of breaking it down piece by piece like we did in example 1, we're going to use the equation. Suppose that when you are 35, you decide to save for retirement by depositing $1,000 into an IRA at the end of each year for 30 years. You can see we've got a 30-year investment here. It would be really aggravating to have to write that equation and do it by hand 30 different times like we did in example 1. So we're going to use the equation that we now have for annuities to determine this real quick, fast, and hurry. If you can count on an interest rate of 10% per year compounded annually, how much will you have from an IRA after 30 years? Okay, so we're depositing $1,000 into an IRA for 30 years. We want to know how much we will have in that IRA after 30 years. Okay, and then we're going to find how much of that is the actual interest. So let's start with this formula that we have. If you need to write down the formula, help you remember it, that's fine, so you can refer back to it later. That'd be a good idea. But here it is. A equals P times 1 plus R raised to the T minus 1 over R. Now, let's break down our problem. Remember, we are investing $1,000 into this annuity every year. We're keeping it in there for 30 years at a rate of 10%. Okay, so $1,000 gets substituted in for P. 1 plus our rate, which is 10%, 0.10, that's 10%, raised to the T. Keeping it in there for 30 years, so we replace T with 30, minus 1 all over 0.10. Now you can simplify this as all that you want to. You can add 1 to the 10% there and get 1.10. That's all they did in that simplification step. You can go ahead and raise that to the 30th power, subtract 1 from it, and you get yourself all the way down here to the last step. Hopefully we can use our calculator pretty well at this point to do simplification factors. We don't have to do this by hand. Use your calculator, solve it on out, right? So we simplify it on down, and we see that after 30 years, by investing $1,000 per year, we will have approximately $164,494 from the IRA at investing just $1,000 a year for 30 years at a 10% return rate. Okay. Now, let's see how much of that is actually interest earned. Okay. So, let's look at the interest earned on this. I've got $164,494. Now, we invested $1,000 for 30 years. That means we invested $30,000 total over those 30 years. Okay, so all we're going to do is take what the annuity is worth at the end of those 30 years. We calculated that here. Subtract what we invested over those 30 years. That's the $30,000, because $1,000 a year for 30 years. And what is left over is the interest that is paid. So, at a 10% rate here, we are making $134,494, and all that we're investing per year is $1,000 for 30 years. Okay, it's a lot of money, also a lot of time, but it is indeed a lot of money. At just $1,000 per year, 10% is a great rate of return as well. We are going to make $134,494. The interest is nearly 4.5 times the initial amount of your payments. Okay, that is, like I said, it's a great return. If you invest money and you get a good return on it, you can make a lot of money if you're willing to let it sit and accrue that interest over time. All right, so now let's look at the value of an annuity with interest compounded in times per year. If P is the deposit made at the end of each compounding period for an annuity that pays an annual interest rate R in decimal form compounded n times per year, the value A of the annuity after 10 years is P times 1 plus R over N raised to the NT minus 1 all over R over N. Now it should look a little familiar here because we used this R over N raised to the NT style formula last section. So you should see some familiarity here, right? Because now we're compounding over a certain number of times a year versus compounding just one time a year. Like I said, write the formula down, write what it's meant for. That way you can refer back to it later. All right, example 3. Let's determine the value of an annuity. But now we're not going to be compounding per year. We're going to be compounding on different terms based on the year. Okay. So at age 25, to save for retirement, you decide to deposit $2,000 at the end of each month into an IRA that earns the equivalent of 7.5% per year compounded monthly. How much will you have from the IRA when you retire at age 65? Let's find the earnings from this investment. Okay, so you're starting at age 25. You plan to retire at age 65. That's a difference of about 40 years. Okay, so a difference of about 40 years. We're going to get a 7.5% return on it, and all we're doing is depositing $200 per month into that IRA. Okay, note this isn't a yearly thing now, it's a monthly thing. Okay, so let's set this up for A. The amount that you will have in the IRA is its value after 40 years. Already discussed this. Let's start with this formula we have. A equals P times 1 plus R over N raised to the N minus T minus 1 all over R over N. Okay, let's do some substitutions here. Now we are investing $200, right? So that is our P here. So we invest the $200. We're going to multiply that times 1 plus our rate here. Remember, our rate was 0.075, straight from the problem. And we're doing it monthly, so our N here is 12. Remember, monthly, there's 12 months in a year. So that is why we have to break it down with the 12 here. We're going to raise that to 12 times 40, because remember, we're investing, like it said, for 40 years. Subtract 1, divide that over your rate, divided by the number of times per year. Once again, monthly is 12 times per year. Now all it is you taking the time, typing it in your calculator correct to simplify. Okay, we simplify a few steps for you here just to make sure you can type it in correctly here. But what we wind up with at the end is $604,765. Okay, so at age 65, you will have approximately $604,765 from the IRA. Pretty cool, right? And $200 a month, depending on the job you have, might not be that much, especially, college degree. That's what we're all hoping for, hoping that you get here. Get that college degree, set aside $200 a month, get a decent rate. It's like 6.25 is not too far-fetched of a rate to get, right? And make some good investments with that IRA. And when you retire, you'll have $604,765 sitting in an account waiting for you, right? Let's see how much of that was actually interest, though, because we did pay money monthly for 40 years of $200. So let's figure out what interest was accrued here. So going to do that the same way we've been doing that. We're going to take the value of the IRA, which was $604,765. We found that in Part A. We want to subtract the total deposits. Now this makes up our total deposits here. This is broken down into what we pay per month times the number of months per year. That's your 12 times the number of years, right? So 12 comes from the month. 40 comes from the year. This is our investment, right? $200 per month. So what we wound up investing over our 40-year period was $96,000. What we actually returned in value for the IRA was $604,765. If we subtract those two numbers, we see that we have gained in interest $508,765. So $508,765,000. That's a lot of money. So the interest is approximately $508,765, more than 5 times the amount of your contributions. Like I said, a lot of money. You do have to invest. You have to keep it in there. You can't be tempted to take it out over that time period. You just got to let it accrue. But if you wait the 40 years, you're consistent about that investment, and it keeps that percent return, you could indeed have a great retirement in that IRA account. All right, let's look at regular payments needed to achieve a financial goal. So sometimes we don't necessarily want to look at just retirement, right? Maybe we have some other financial goal that we want to set aside, whether it be buying a house, buying a car, buying a piece of land, or paying off a certain bill, and we need a certain amount to do that. Okay, who knows what it might be. It might be even just money set aside for a trip. But let's set this financial goal and see what kind of regular payments we need to achieve such goal. So the deposit P that must be made at the end of each compounding period into an annuity that pays an annual interest rate R in decimal form compounded N times per year in order to achieve a value of $8 after T years is P equals A times R over N over 1 plus R over N raised to the NT minus 1. Okay, like I said, If you feel like you need, it wouldn't be a bad idea to go ahead, write the formula down, write down what the formula is for, just to keep it nearby. I don't care if you use the formulas to work some of your problems. I'd rather you get the right formula and work it out correct, right? This is a lot to memorize. I don't expect you to memorize the formulas for this class. I expect you to be able to work the formulas in the correct circumstance. So feel free to write it down, keep a note of it for later. All right, so let's suppose that once you complete your college education and begin working, you would like to save $20,000 over 5 years to use as a down payment for a home. You anticipate making regular end-of-the-month deposits in an annuity that pays 6% compounded monthly. How much should you deposit each month? And then part B is going to say how much of the $20,000 down payment comes from deposits and how much comes from interest. All right, let's break it down. Let's find how much we should deposit each month based on this large formula that we had right there in our initial definition. Okay, so we'll start with the formula. I'm not going to reread it at this point. You can read it for yourself. It's sitting right there. All right, our goal is to make $20,000. We want that $20,000 for that initial down payment on the home, right? Our rate in this problem is 6%. It says it right in the problem. So we got a rate of 6%. We're making end of the month deposits. Remember, month and monthly is 12 times a year, right? $20,000 initial deposit. I think that pretty much covers everything in the problem. Let's see what we got here. And one more thing. We're trying to do it in 5 years. That's also important. Okay, so $20,000 goes in because that's what we want to have at the end of that 5 years. We've got a rate of 6%, so 0.6 or 0.06 N for our R over 12 for our N, divided by 1 plus our rate 0.06 divided by, once again, our N is 12, raised to the 12 times the number of times per, or the number of years, our T, which is 5, minus 1. All we have to do is simplify that. Okay, we simplify that out, we get that P is approximately $287. So as long as we can deposit $287 each month for 5 years, at the end of that 5 years in this interest returning account here that has a rate of 6%, we will have $20,000 saved up in 5 years for the down payment on our home. Okay, no problem, right? All right, so let's look at this though. Like, okay, we're putting a lot of money into this account. Let's see how much of that money at the end of those 5 years is just money that we're saving versus money that we're actually gaining on interest. Because the interest is the money that you want, right? I mean, anybody can just set money aside and save for it. The interest is what makes these accounts so sought after, I should say, or so interesting. Okay, so let's look at the total deposits we've made over these 5 years. So the 287 is what we're depositing every month to reach our goal. Okay, we saw for that in part A. 12 is the number of months in the year, right? Because we're depositing once a month, and 5 is the number of years that we're depositing over. So the 287 times the 12 times the 5 multiplies to give you a total deposit amount of $17,220. Now, we saved $20,000 because we met our goal. We had to do $287 a month to meet our goal. So we made our goal of $20,000. If we subtract the $17,220 from the $20,000, we see that this IRA account here has made us $2,780 in interest. So a lot of the money out of the $20,000 is just money we straight up saved. But we did gain almost $3,000 in interest. We gained $2,780 in interest from this account. So that IRA did help us get to our goal, right? It was taking us a good little bit longer, quite a few months longer, 10 months to a year longer to gain the overall amount. So it did cut some time for us. All right, so let's look at investments, risk versus return. Now, when depositing money into a bank account, you're making a cash investment. The account's interest rate guarantees a certain percent increase on your investment, and it's called a return. Okay. Other kind of investments are riskier and are called stocks and bonds. So with a cash investment at your bank, you're guaranteed a return based on the amount that they're going to pay you on that interest rate. Okay. But if you decide to invest in stocks and bonds, you're making a riskier investment. Okay. Because with stocks and bonds, you don't necessarily make a set rate and you could potentially lose money. So with stocks, investors purchase stocks, which are shares of ownership in a company. For example, if a company has issued a total of 1 million shares, an investor owns 20,000 of these shares, then the investor owns 20,000 divided by a million, or 2% of that company. Okay, so any investor who owns some percentage of a company is called a shareholder. Okay, buying or selling stocks is referred to as trading. Stocks are traded on the stock exchange. There are two ways to make money by investing in stock. You sell shares for money or for more money than what you paid for them, in which case you have a capital gain of sale stock. While you own the stock, the company distributes all or part of its profits to its shareholders as dividends. Okay, so you got a twofold thing here basically. So you're buying the stock, right? You could sell the stock and make capital gains, but while you own the stock, the company distributes all or part of its profits to its shareholders as dividends. So while you own the stock, you're also making money if obviously they're making profits. If the company is not making profits, you are not making dividends. All right, let's look at bonds, though. Let's look at this other one called bonds that still says it's risky. So in order to raise money and dilute ownership of current stockholders, companies sell bonds. People who buy a bond are lending money to a company from which they buy the bond. Bonds are a commitment from a company to pay the price an investor pays for the bond at a time at which it was purchased, called the face value, along with interest payments at a given rate. A listing of all the investments that a person holds is called a financial portfolio. Most financial advisors recommend a portfolio with a mixture of low risk and high risk investments called a diversified portfolio. Okay. Excuse me. All right, so let's look at reading stock tables. Daily newspapers and online services give current stock prices and other information about stocks. The company name is shown at the top of the chart. Okay, so if we look at this chart here, the name of the company is at the top of the chart. Here we have Apple Inc. Let me get my pen working. Here we have Apple Inc. That is the name of the company. All right. Under this, the stock exchange is given. Okay, so if we look at the stock exchange, it says this one here says NASDAQ AAPL. Okay, the AAPL to the right of that stock exchange, the stock exchange is the NASDAQ, the AAPL is the trading symbol. Okay, so the trading symbol is that AAPL right to the right of the stock exchange. Okay, the number shown in a larger font size is the closing price in dollars. Okay, so the closing price here was $145.11. Okay, so just a basic on how to read some of these charts. You got some other information as the O, the high, the open, the high, the low. Got some time periods on it when the market closed, the time period the market closed, the 52-week high, the 52-week low, your average volume, current volume, market cap, etc. Okay. Now, looking at those more specifically, because I just kind of ran through them kind of quick. Let's look through the rest of them. So the opening price is what's labeled as open. You see that here. Okay. The high of the day is labeled here because we know stocks and bonds go down sometimes by the second, right? So the high of the day here was $145.65. The low of the day was $142.65. Okay. Got your low right there. Your net change is shown in the green right here. Here we had it'll be shown in green if it goes up, could be shown in red if it goes down. So our net change was up 1.87 or 1.31%. Like I said, there's a couple other things in there too that if you get well into the stock market you might need to know. In the second row, the 52-week high refers to the highest price at which Apple stock traded during the past 52 weeks. So we can go look at that. The 52-week high there, you can see that was 145.65. The highest price was $145.65 per share. This means that during the past 52 weeks, at least one investor was willing to pay $145.65 for a share of Apple stock. In the third row, the 52-week low refers to the lowest price at which Apple stock traded during the past 52 weeks. This price is $89.14. So we see the 52-week low is $89.14, right there. That's the lowest price that somebody was able to gain that stock for. In the final column of the chart, VOL, VOL, refers to the number of shares traded on July 9th, 2021 in millions. Thus, 99,890,000 shares of Apple were traded in that one day. In the second row, average vol, or average volume, refers to the average number of shares traded per day in millions over a fixed period. The average volume is provided for comparison purposes. Since the volume of shares traded on July 9th, 2021 is greater than the average volume of 77,190,000 shares per day, we see that the trading of Apple stock was heavier than normal on this day. Finally, the market cap, MKT cap, refers to the total value of all a company's shares of stocks, given here in trillions of dollars. Thus, the total value of Apple stock, big number here, right? So we'll look at it. We got hundreds, 100,000s, 100 millions, 100 billion. So it's $2,420,000,000,000 on July 9th, 2021. I honestly don't get to reading the trillions that often. I definitely don't have that kind of money, but might wish I would. Don't know what I would do with that kind of money. But if we look back here and look at the market cap, the vol, and the average vol, that was on that right-hand row right here. We can see all those values right here. Volume, 99.89 mil. Average volume, 77.19 mil. Market cap, 2.42 T, which stands for trillion. Easy enough. So PE stands for the price to earnings ratio. The PE ratio equals the closing price per share over the annual earnings per share. Okay. So let's use the stock table for Amazon to answer the following questions. So this is your Amazon.com Inc. stock table right here, traded on NASDAQ. Right. We can see that it's down because we've got a down arrow in 12.07%. It's down 0.32% right there. We can see all the other information about it. This is July 9th at 7:59 p.m. And Amazon does not pay dividends to its share owners. I guess it just all goes to good old Jeff Bezos. Anyways, that's beside the point. So we're going to use the stock table for Amazon to answer the following question. What was the closing price of a share on Amazon stock on July 9th? Was the closing price up or down from the previous trading day? By how much? What was the closing price on the previous trading day? What were the high and low prices of Amazon shares on July 9th? What were the high and low prices for the past 52 weeks? How many shares of Amazon were traded on July 9th? Was the trading volume below or above average for Amazon on this day? What was the total value of Amazon stock? And we want to compute Amazon's annual earnings per share using the annual earnings per share equals closing price per share divided by the P-E ratio. Whoo! Long question, right? So let's start it one by one here. What was the closing price of a share of Amazon stock on July 9th? All right, so I'm going to look at the chart here. We're looking for the closing price. Closing price is the big number right there. So closing price, boom, right there, $3,719.34. Was the closing price up or down from the previous trading day, and by how much? Well, like I said, we got a red arrow here indicating it was down. It was down by $12.07 or 0.32% right there. It says it right next to that closing price. What was the closing price on the previous trading day? We can mathematically determine that by taking what the closing price was today, and if the price was down $12.07 today, that means that yesterday it was $12.07 higher, so I can just add the $12.07 to the closing price of today and figure out what yesterday's closing price was. Alright, so yesterday's closing price, if I add those two numbers together, is $3,731.41. If I'm going too fast for you, this is the beautiful thing about it being on YouTube. You can clearly pause this, work these problems by yourself, see if you can figure it out, and then check it to the answers. I highly recommend doing that. Okay, so don't feel like you should have to be going this fast through it. Take your time, pause it at each question, and go through it individually. All right, let's look at D. What were the high and low prices for Amazon shares on July 9th? All right, high and lows, all we're looking for right here. So, high right there, low right there. So the high was $3,748. The low was $3,693.40. E's going to ask, what were the high and low prices for the past 52 weeks? Well, that's right here. High was $3,759.99. The low was $2,871. Okay, right there in the chart. We can find them. If asked how many shares of Amazon were traded on July 9th, was the trading volume below or above average for Amazon on this day? Okay, so for this day, we're looking at the volume. The volume done on this day was the 3.75 million. Okay, the average volume is 3.40 million. Okay, so on this day, we could tell that, okay, this day we did 3.75. On average, we do 3.4. So this day is heavier than normal, or we sold more than normal. Pretty straightforward from the chart, I feel like. All right, let's look at part G. What was the total value of Amazon stock? Well, if we go down here, look at the total volume of Amazon stock. That's located right here in the market cap. Remember that the T stands for trillion here, so we're looking at $1.88 trillion. More money than I'll probably ever see. All right, part H, compute Amazon's annual earnings per share. Okay, so we're looking at the annual earnings per share. Remember that equals the closing price per share over the P-E ratio. All right, now here's what we're going to do. We're going to write this formula down, okay? If you have a hard time with formulas, and we've gone through quite a lot of formulas in this particular chapter, feel free to write them down so we can refer back to them later. All right, so let's start with the closing price per share. That's the $3,719.34. Okay, you're going to ask me where that comes from. It comes from, where'd my pen go? Trying to get my pen to line up. What happened? Pen's not working. All right, I think I found it. So, pen's working now. This is your closing price. Remember that big number is your closing price. We need to divide that by the P-E ratio. Well, where's the P-E ratio? It's right here in the chart, 71.01. We do that simple division right there, and we see that it is $52.38. That's the annual earnings per share, $52.38. All right, let's look at retirement savings, stashing cash, and making taxes less taxing. All right, you can use a regular savings and investment accounts to save for retirement. There are also a variety of accounts designed specifically for retirement savings. A traditional individual retirement account, an IRA, is a savings plan that allows you to set money aside for retirement up to $6,000 per year for people under 50 and $7,000 per year for people 50 or older. You do not pay taxes on the money you deposit in an IRA. You can start withdrawing from your IRA when you're 59 and a half years old. The withdrawals are taxed. Okay. So we have a little bit of a delayed tax with this traditional individual retirement account, this IRA. Okay. So we're basically putting money into it. We can't withdraw any money until we're 59 and a half years old. Once we do start withdrawing, those withdrawals are going to be taxed. We have a Roth IRA. A Roth IRA is a type of IRA with a slightly different tax benefits. You pay taxes on the money you deposit into the IRA, but then you can withdraw your earnings tax-free when you are 59 and a half years old. Although your contributions are not tax deductible, your earnings are never taxed even after withdrawal. So, a Roth IRA could play into effect depending on the tax ratio of when you deposit versus when you withdraw. If you feel like it's kind of one of the things you kind of got to gamble on, right? So if you feel like taxes in the future are going to be a lot lower, then it would be worth deferring those to when you withdraw with a traditional IRA. If you feel like the taxes are as low as they're ever going to be and they're only going to get higher, then you might want to look into a Roth IRA, or you go ahead and pay the taxes, and then you don't have to pay any taxes on any year withdrawals after you're 59.5 years old. Okay. You also have employer sponsored retirement plans. Now, these are popular here, including the 401k or the 401(b) plans. These are set up by your employer, who often makes some contribution to the plan on your behalf. These plans are not offered by all employers and are used to attract high-quality employees. So not all jobs offer you a 401k or a 401 or a 403(b) plan. Some employers do. They are traditional style retirement plans offered by employers, though. Alright, so you got some options when it comes to retirement. You can make some decisions. These are just 3 of them right here. Good to know the definition of them and what you're kind of dealing with, at least on a general basis. This pretty much completes, like I said, completes this particular section here. If you have any questions, please feel free to reach out to me via email. Go ahead and try the associated assignment and the problems associated with this particular section. I'm always available via email if you have any questions. Other than that, I will look forward to talking to you on the next lecture.